Hey, welcome back to the Daily Dive. Today we're joined by Ihor Dusaniwsky of S3 Partners with the goal of learning more about the mechanics of short selling. Ihor, welcome to the dive.
Oh, thank you for having me.
So first off, can you explain how synthetic longs are created? And secondly, can you explain the relationship between synthetic longs and short positions?
Well, short interest pleasure float is a very traditional calculation that is basically share shorted over the float of a company. The interesting twist that we've kind of come up here with S3 is that for every short sale, there is a synthetic long created. So basically, a long shareholder lends out his stock, a short seller borrows it, shorts the stock, and delivers those shares to the market via DTC or an exchange or via its broker. Now, the person buying the stock has no idea that it's the result of a short sale. They don't know whether it's a long person selling or a short person selling the stock. All they know is they're receiving on settlement date a share of stock. So after the trade settles, you've got the long shareholder that lent the stock is still long the stock. They just don't get voting rights or actual dividends sent to them. And the new buyer, who is the result of that short sale, is also long the stock. So at the end of the day, you've got two long shares, one short seller, which means that you just create a synthetic long.
Sometimes we see companies that have short interest above 100%. Can you explain how this happens?
Yeah, and this is my pet peeve, and I was sitting around looking at these numbers for a while, and just kept gnawing on me that you can't get 5 quarts of milk out of a gallon jug. It's having anything over 100% is just impossible. It's illogical. So I was sitting around trying to figure out how this happens. Why is this number being calculated on? It doesn't happen that often, but it happens often enough where you see it. And I realized that they weren't taking into consideration that the float is being increased by these synthetic shares. So the market capital of the company doesn't change. They still issued, let's say, a million shares. The thing is that there's 1.2 million shares being traded on the street due to the synthetics. So it creates that 120%, 110% of float. So it's purely bad math with the traditional short interest percentage of float calculation, good math with the way we calculate it now.
How is the borrow rate on a shorted stock set?
Yeah, so people kind of wonder whether this is kind of arbitrary or not, but I've been doing stock loan for, around 30 years. So you really realize that stock loan is a very much a supply demand driven market. So if there's increased demand or decreased supply, stock rates go up. If there's decreased short demand and increased supply, stock rates go down. So something like a Tilray, some of these big stocks that are heavily shorted. Well, the supply has been kind of taken down a lot. So the lenders say, well, there's still demand on the street. I'm going to try to get more from my stock borrows, and they start raising the price. As long as that stock rate is within the expected alpha or the expected profits that the short seller is going to be generating, he'll pay that extra rate because he's willing to pay, let's say, a 5% fee to make 20% return. So rates start going up.
You recently tweeted out that GameStop shorts are not covering. Does this mean the short position has cycled to new shorts, or the original short sellers have held through the price rise?
Yeah, well, that was last week that we kept seeing the share shorted number kind of remaining stable. We at S3, we're a technology and data platform, and one of the things we do is we create our algorithms, get publicly and non-publicly disclosed numbers, and we create share shorted on a daily basis. So you're not dealing with 2-week-old stale numbers that are reported by the regulatory agencies. So what we were seeing was there wasn't a decrease in share shorted as the stock price was going up, which to us and to our clients meant that this was a long buying rally. People were buying the heck out of the stock, forcing the stock price up. Shorts were getting clobbered. At one point, they were down, $30 billion in mark-to-market P&L. What we recently saw was that the shorts started getting out of their trades. Basically, they got so bloodied that they said, I'm done. When we had a pullback in GME stock price, they found exit points and they started leaving the trade. So over the last 30 days, well, last 7 days, sorry, we saw 36 million shares covered. So we haven't seen a decrease in share short in GameStop. So, by more than half over the last 2, 3 days.
We are a Canadian small cap platform. We often hear about naked short selling. Is that possible with the American exchanges?
All right, naked short selling to me is kind of like Bigfoot. It's talked about a lot, but it really, really doesn't exist. People have to understand that one of the first things that a regulatory agency looks at when they look at a broker is, do you have locates for all your short sales? Now, you might have a few that fall through the cracks, or you might have some smaller brokers that kind of play on the on a little bit loose with that. But really, every broker gives a locate for a stock. Now, the issue is that at the day of the short sale, a short seller has to get a locate, meaning they have to talk to their broker and say, can you borrow the stock for me and let me short sell the stock? Now, the broker has to have a reasonable expectation that they can borrow the stock and do delivery. Now, in those 2 days where they have to deliver the stock, something might happen and there might be an issue with being able to borrow the stock. So, nothing stays the same in the market. So on Tuesday, everything looked fine. I can borrow 1 million shares. Yeah, go ahead. You can short 10,000 shares. All of a sudden by Thursday, all those million shares are gone. And now I'm scrambling to try to find something for my settlement. And that's what causes some of the fail to deliveries. It's just a timing of when they get the stock and when they deliver the stock. But really, naked short selling, I got a better chance of seeing Bigfoot in the Rockies.
Do you have any sense of who is losing money with all the various short squeezes?
Yeah, and it's really the fundamental guys. Everyone who was in early in the trade for GameStop was the ones that are really losing the large amount of cash on this trade. So it's really the guys who shorted the stock at 40, $50, and the stock ran up to 300. Those are the guys who are really feeling the pain on this trade.
What risk do the short squeezes pose to the overall financial system?
That's a great question because a lot of people look at the short side as a bad trading practice and has some sort of evil undertones. Uh, Really, the risk we're seeing with short squeezes is that you've got a problem with liquidity in the market. If there is you're forcing the shorts to buy stock and getting out of the name, you got to see, are there people willing to sell it? So that's causing some upward price movements in the stock that are probably a little bit unnatural and forced. If all of a sudden you have 10 million shares of stock that's being squeezed on the short side and people want to buy the cover, but there's no one selling on the long side, well, the price starts ratcheting up at really quick and high rates. So it could cause the stock to go from 200 to 250 to 300 really, really quickly. And the problem is then when the shorts stop covering and stop buying, there's no buy supply holding the stock price up, and then it plummets really quickly too. So you get this huge amount of volatility in the market if there's a lot of short squeeze activity in the name.
In your opinion, was the blocking of certain securities on Robinhood simply a question of Robinhood needing more capital for clearing the trades, or do you think there may have been some nefarious moves being played?
Now, I started out in this business a long time ago in controllers, so I had to keep filling out these forms for balance sheet usage, capital requirements, and such. And there was always management on, for the broker to make sure that as long as his shorts, his debits, and credits were in balance, and your month end was correct, and you didn't have these capital squeezes. Now, in a firm like Robinhood, that doesn't have a ton of capital sitting on the balance sheet that they can access, some like the big banks do. Any changes on their retail holdings can change their debits and credits, their longs and shorts, and force them to have to put up more collateral at the DTC or any other regulatory agency. So it really puts a lot of tremendous pressure on they're able to do business in the future because they can't produce the collateral necessary to settle trades. So I think that a lot of this was really due to capital restrictions that they had to impose on themselves in order to keep themselves solvent within the trading community.
So, how does S3 Partners collect short data differently?
Well, the primary thing that we do is we actually report short interest. So we're not reporting stock loan as a proxy for short interest. We're actually sitting here collecting data, both public and private. So we have regulatory reported data. We have data from exchanges. We have data from brokers. We have our own over $2 trillion worth of assets on our platform. We collect all this data as well as other things. and our algorithm calculates the daily short interest. So the differentiation is we're truly short interest, share shorted, and we're calculated on a daily basis. So you get no lag and you get the right number.
If someone in our audience wanted to access your platform, how could they sign up?
Sure, we have both institutional and retail apps and SaaS platform that investors can look into. So you can go to s3partners.com, check out our institutional side. You can go to shortsite.com, check out our retail side. We're actually kind of increasing the usefulness of our retail app and making it so that we're disseminating information to the whole street. I mean, that's one of the big things that we do, is that this information used to sit just with the big institutions, and now we're kind of getting it out to everyone. So now everyone can make the correct trading strategy based on knowing everything about the market.
Well, Ihor, thank you so much for joining us on the show today.
Great, it's been fun. Thank you very much for having me.
And for our viewers at home, don't forget to like, hit subscribe, hit that notification bell. We'll see you next time on The Dive to talk all things small caps.